Hey, welcome to Financial Wellness University. I am your teacher and coach, Joe Brown, and today we're going to be talking about buying real estate and more specifically, paying for it quicker without breaking the bank. Stay tuned. Well, as I said, we're going to be talking about real estate, buying real estate, and paying for it expeditiously so that we don't have that debt hanging over our head for the majority of our lives. If you haven't done so already, please subscribe, hit the bell, and hit that like button so that these YouTube videos will be seen by more and more people, because more and more people need help in terms of how to buy and how to pay for real estate in a way that eliminates the debt. So let's begin with this. One, the thing about real estate, if the buying is the beginning, of course, but how you buy determines everything else. Because if you buy high, if you buy wrongly, incorrectly, it determines the enjoyment that you're going to get from that real estate. So just a few parameters when it comes to buying. One, try at all possible to have at least 20% down. 20% down. That means if your property that you're buying is worth $200,000, try to put down at least $40,000. Now that sounds like a whole lot, but what it does is it leaves you in a position where you come into the property with some equity. And what is equity? Equity is the amount that you would get back if you were to sell it. So if you have a property and it's worth $200,000 and you've paid down $100,000 of the mortgage, in essence, if you were to sell it, you owe the mortgage company $100,000. So that means you would have $100,000 in equity. Say, for instance, if the house was $300,000 and you paid down $100,000, that means you still owe the mortgage company $200,000, and you have $100,000 in equity. Meaning, if you sell it, you can still walk away with $100,000. So to begin with my first example, house price is $200,000. You come up with a down payment. Now, if the down payment is less, then now, of course, VA loans, you can get zero down and avoid the PMI, but the terms, you can buy it with zero down. You can buy it FHA loan. You can buy VA loan if you're a veteran. And a lot of people buy homes with no, but just know that the drawback is, say for instance, the housing market slumps. You owe $200,000 on a $200,000 house, but instead of the house appreciating, it goes down to 190, 180, 175. Now, if you had to sell it, you owe more than what the house is worth. That's called having an upside down mortgage. But if you would have used the technique of putting 20%, 20% down, you would have avoided that, because you would have some equity that could cover that gap, that loss, and still walk away with some money. Now, it would still be a loss of some of the money you put up, but you would get out without owing the mortgage company more than what the house is worth. So at least the house could produce enough to pay off your mortgage, and you can walk away free and clear. So that's very important. One other thing is that we get out of all the consumer debt before we commit ourselves to paying on a home. And because that frees you up to handle any things that will happen with the house. Not if something happens, when something happens with the home. So that frees you up. So you have money coming in your pocket that's growing because there's no other claim on that money than your mortgage. The only debt that you should have when you take on a mortgage is that mortgage. All other debt should be paid. So that helps you also. Now, 30-year versus 15. Well, 30-year payments will give you a lower payment, but the interest will be so much more over the life of the loan. So your guide, what I'm suggesting to you is it should be 1/4. The mortgage payment, the total mortgage payment should be around 1/4 of what you bring home in a month. So for instance, if you bring home $4,000 per month, your total mortgage payment should not be more than $1,000. Now, I know if you go to the mortgage company, the bank, they're going to say, oh, you're approved for a huge house that might wind up being a $2,000 a month payment. And they look at your total finance, they say, oh, you make enough to pay this. But it's imbalanced to the other part of your budget, because if you bring home $4,000 and have a $2,000 mortgage, that's half of what you bring home. That means if something else was to come up, you only have half of what you bring home to take care of all the other expenses, all the utilities, all the other things that you would pay for, food and transportation, all those other things, all the other lifestyle things like movies or entertainment. You have less than half of what you make to take care of. So that's putting a strain on your finances right from the beginning. So start off right by, one, trying to put down as much as possible to the house that you buy. 2, try to get a 15-year mortgage, which means 15-year mortgage which equals less than a quarter, around a quarter. I mean, if you go up to 30, you're not terrible, but around 25% of your take-home pay. And if you make $4,000 and the payment should be around $1,000. Now, that will help you with a 15-year mortgage, because you're gonna have a lower interest rate, and you're gonna pay it off in 15 years, or at most 15 years. Now, the other trick to that, if a 30-year mortgage, if you currently have a 30-year mortgage, you can pay it off, and you've increased your income where you can afford the 15. Then you can just add money. But we'll talk about how to increase your payments in just a second. So if you have a mortgage, you say you get a 15-year mortgage and you're paying it down. Well, after you get into this mortgage and you realize it's going to take me 15 years at this rate. Now, let's look at what makes up that payment. If your payment is $1,000, okay, let's just say 700 of it is what makes up the principal and interest amount. Now, principal is what you owe. The principal is, so you borrowed $200,000. Well, you're paying that $200,000 back over the length of the term, 15 years, 30 years, 10 years, whatever the term it is. We're looking at 15 in this case. You're paying a portion of that principal every month when you pay back. But you're also paying a portion of interest. Now, in the early years of a mortgage, you're going to be paying more interest than you are principal. Why is that? Because one, the bank, the mortgage company, they're in the business of making money, and they want to make as much interest in the beginning part of the mortgage as they can. And as the loan matures near the end of it, you're going to be paying majority principal payments. But they want their principal payments quick. One, you might sell the property now, or you might sell it, and then they don't hardly get any money from the loan, or you might refinance with another company. Now they lost all the potential interest that they get, or you could default, which we hope you don't do if you follow some of these simple principles up front, that you'll be in a stronger position. So default is not something that you'll do. In addition to being out of debt, also we should have at least 3 to 6 months worth of income, of take-home income in the bank. So if you're bringing home $4,000, as the example earlier, if you bringing home $4,000, your mortgage is $1,000. 3 times 4 is $12,000. So if you had $12,000 or 6 months worth, $24,000. If you had $24,000 worth of money in the bank or set aside, that means you can literally pay that mortgage. Just raw numbers. If you didn't pay anything else, you could literally pay that mortgage, that $1,000 mortgage, for 2 years without trouble. That's amazing, isn't it? You can pay your mortgage, even if you lose your job, you could pay the mortgage and not lose your house for 2 years. Now, it shouldn't take 2 years to find another source of income. That's why most financial experts recommend 3 to 6 months. Most people can find some other source of income within 3 to 6 months. Even if it's not as high as the one they had, you can find something. But before you buy, if you have that money set aside, it gives you a cushion in case things come up that would impede your ability to pay that mortgage. And another reason to pay more upfront, 20%, because the mortgage company will charge you what's called PMI, primary mortgage insurance, which is basically another cushion that the mortgage company uses to make sure that they get their payment in the case that you can't pay. All right, so we started to break down the mortgage payment. The mortgage payment is broken down into principal and interest. Let's say if you're paying $1,000, 700 of it is mortgage, principal and interest. And the principal part might be only about 200 or 300, and the bulk of it is going to be interest. It's going to be an interest payment. Now, I only went through 700 of that 1,000. The other portion of your payment is going to be is called your escrow for your property tax and your homeowners insurance. Any person, any entity that's going to loan you money, you want to make sure that, one, you're paying your taxes, because they don't want you to lose your house to the municipality, and that tax lien is going to take precedence, and they don't want to fight with the municipality over the house, because the tax lien will sell it for very little just to pay the taxes, and now they're stuck. So they're going to agree to set it up where they can pay your taxes for you and your homeowners insurance through an escrow payment. That's $300. That's, for example, that it's made up of that remainder of that mortgage payment. So $700 is the principal and interest. The other $300 is an escrow for, and escrow simply means it doesn't go into their profits in terms of what they make, but it goes into a separate account that they just hold the money, so when the tax payment comes up, they'll have accumulated enough to pay it off. When the homeowners insurance payment comes up, they have set aside enough to pay it. Now, how do we get lower payments? How do we get lower payments or speed up the payment of the loan? Well, there's a few methods out there, and I encourage you to steer away from ways that encourage you to get into more debt through this thing called velocity banking. There's some people who are good at it. Some people are experienced and good at playing around with debt, but I don't recommend you play. It's like recommending you play with fire. You know, you might not get burned the first time, but if you play with it long enough, you're going to get burned. So I want you to get out of debt quicker. But the first way I'm going to recommend that you get out of debt is to get out of debt with your mortgage company without paying any more than you're currently paying. And how are you going to do that? How can you make it quicker without paying any more? One, you can go to your mortgage company and say, do you offer bi-weekly payments? What is that? Instead of paying once a month, so your mortgage interest is going to be reduced 12 times throughout the year, through 12 times. 1 step, 2 step, up to 12 steps. Now, what does that mean? Every month, your principal is going to go down very little, and now the interest that you pay on that is going to go down too. So, say for instance, on $200,000, the interest, say if it's 3%, that's going to be $6,000. Or just say you got $100,000 left. You got $100,000 left on your mortgage. The interest, the 3%, would be $3,000. But if your principal goes down to 90, 3% of that is $2,700. If it goes down to 80, the interest, the 3% on that is $2,400. So you see, the lower your principal, the lower the interest. So if your mortgage payment goes down, if your principal goes down once a month for 12 times, that means the interest you're paying on that goes down 12 times. But if you get bi-weekly payments, that all of a sudden gives you 26 payments. Now your interest goes down every 2 weeks rather than once a month, but it goes down 4 times a month. So you speed up basically the payments on your mortgage by making a simple move of just paying more. And of course, if they offered it, if our officials would really push something especially during this pandemic, and allow us to have 52 payments. I mean, it's all computerized. It's not like someone is in a room figuring it out. If they allow us to make 52 payments, we can really drastically pay our mortgage off, because we would be paying it one a week instead of once every 2 weeks, which most companies or many companies offer, but they should offer it once a week or even daily. Make a daily payment, make 365, but you know, that would probably blow up their computers if everyone did that. But the idea is that the more payments you make, the lower that principal gets, and the lower the principal is, the lower the interest. So in say if it was 15-year mortgage, that might shave off 2-3 years, maybe a year, 2-3 years. So a 15-year mortgage is now a 13-year mortgage just by double payments. Now, if you had some extra money, you don't have to have $1,000 a month. You can start with $25 extra. You can go to you can say $25 goes to principal every month. So you're lowering it every month or bi-weekly. If you $25 every 2 weeks, whatever you can afford. But the idea is that you don't have to have a major principal payment in order to pay down your principal. Every little bit helps. Now, like I said, the first bi-weekly suggestion, you don't have to pay any extra. It's just paying more. That's what cuts it down. Now, say for instance, just what's recently happened to me is my mortgage company sent me an escrow overage check, which means they had more money in the escrow than they needed to cover my taxes and my homeowners insurance. One reason why that happened is because I shopped around and got a lower homeowners insurance throughout earlier in the year. So my homeowners insurance basically went down by $1,000. Now I didn't sacrifice the service or coverage, but I just shopped around and found a company that would offer the same kind of coverage, for less money. And a good source to find out which insurance companies, homeowners insurance companies, really cover you if you ever have a loss is talk to some of those claims adjusters, independent claims adjusters. Don't talk to the ones that work for the insurance company, but independent claims adjusters, because they battle these insurance companies all the time for claims, and they know who pays out. And sometimes the companies that pay out best are not the ones who are or have national ad campaigns, because they work by word of mouth. But but the idea is that shop around for different insurances, not just homeowners, but insurance in general. Shop around for everything, but we're talking about real estate. But if you shop around, you can get a lower cost for the same coverage, and that's really what you don't want. Lower costs for lower coverage, because there's certain coverages you don't want to go without. But so I got this mortgage escrow payment check, and so what did I do? Well, what happens when they gave me that is it lowered my mortgage payment by $200 a month. So now I got a lower mortgage payment. So some people say, "Oh yeah, hip hooray! I got a lower mortgage payment." How do I respond to that? Well, some people would say, "Oh, I got $200 extra. I can go out and buy me a car." Bad idea. Oh, I got $200 extra. I'm a spend this on this. I'm gonna spend it. No, I was already paying that amount. So now what I did was I took that $200 that I saved from the escrow payment that the lower escrow needed, and I applied that $200 to the principal payment every month. So now I'm paying the same amount, but because my overall payment is lower, I can apply that overage to my principal every month. So now I just sped up my payment of my mortgage without paying any extra. Now, personally, I like to pay a little extra. I like to pay a little extra. I've eliminated consumer debt. I invest what I need to invest. So any money that I get beyond my normal expenses is a surplus that I can use to help pay down my mortgage. Now, I don't use the entire surplus to pay down my mortgage, but I use some of it. And what that does is it speeds up your mortgage so that you can get it out your life. But I'm trying to explain it to do it in such a way where you don't have to necessarily pay more right away. You can do that when you first get the mortgage. Ask if they have BiWeekly payments, and if you shop around and lower some of your expenses like your homeowners insurance, or maybe you might have a tax assessment and your taxes go down. Now that's rare where it goes down, but there are instances where the taxes might have gone down a little. That's more money that you can use to throw at the principal. You already agreed or figured out the numbers that you can pay the mortgage. Now, if you were struggling and this $200 came, then that's a extra blessing that you can use to help you get out of your crisis. You don't want to throw that back into the mortgage if you need that $200 to live off. You know, that could $200 can be more used for food or paying down some of your bills. But if that's not a problem, then throw it back into your mortgage and speed up your mortgage payment until you have no mortgage. Now every month you have $1,000 or more that you can use to become even wealthier. So I hope this has helped you. I hope this will help you understand buying and maintaining your mortgage easier when you implement some things up front so that it won't make it hard for you as you go along, and you'll get it out your life quicker, and it'll be something less that you have to be concerned about, and you can use the extra money every month rather than paying a mortgage to invest, to buy other assets that increase in value. So hope this has helped. If it has, again, hit that like button. If you haven't subscribed, please subscribe and hit the bell so that you'll be notified when each video becomes available. Thanks, and God bless.